This presentation will provide information for prospective applicants for Habitat for Humanity Ireland Home Ownership Programme on how to acquire a mortgage. For further information on Habitat Ireland's programme, including application criteria, visit habitatireland.ie/homeowner. Welcome to this presentation on preparing for your home loan, which has been provided by Home Brokers, an independent mortgage brokerage based in Dublin, on behalf of Habitat for Humanity Ireland. The purpose of this presentation is to inform you about the mortgage process and prepare you for applying for your home loan, which will result in an easier and quicker home buying process. Due to the changed economic environment, it can now be more difficult to secure a home loan, and therefore it is recommended that prospective home buyers prepare up to 12 months in advance. It is important that you manage your finances very carefully in the lead up to applying for a home loan. This includes not making any significant changes to your employment status. Of course, the year before applying for your home loan can be instrumental in building up your deposit, which on a purchase price of €100,000 will need to be in the region of €15,000 to €20,000 to include the associated costs when buying a property. Remember, there are a number of criteria that you will need to pass to qualify for your mortgage. Your character, your repayment capacity, and the security you are offering are some of the main factors influencing whether you are suitable for a home loan or not. Let's take a look at some of these now. One of the strongest indicators of your character is your repayment history. A lender will look at your credit history on the Irish Credit Bureau, known as the ICB, for a record of how you have repaid previous loans, credit cards, and utilities. They will also look at your bank statements for other commitments, such as rent payments, and also to assess your overall ability to manage your money. If you have debts, it's recommended that you clear these as early as possible, as large loan commitments can negatively impact on your new mortgage repayment capacity. Unfortunately, this may mean that you do not have available free cash to accumulate the deposit you need for your new home. This is another reason why it's important to start the mortgage application process up to 12 months before. A lender will also look at how the proposed repayment amount will be serviced from your disposable income. You should be able to demonstrate that between your rent payment and your savings contribution, you are comfortably able to meet the new repayment level. It is recommended that the repayment should not exceed more than 35% of your net disposable income per month, when allowing for interest rates to increase by 2%. When assessing your repayment capacity, a lender does not just consider your income. They also consider your employment and how stable or secure it is. A change of employment or employer in the months leading up to your loan application could negatively impact the outcome, even if you have moved jobs to secure a pay increase. The lender is looking for certainty regarding your employment, so they will be interested in the financial stability of your employer and the permanency of your role. So if you're considering a career move, consider the impact on your home loan application too. If you're self-employed, it's really important to make sure that the financial statements for your business are in order for up to 3 years prior to making your mortgage application. If you've been self-employed for less than 12 months, it is unlikely that you will be able to secure a mortgage approval at this stage unless you have a very strong contract underpinning your business. We're now going to look at a case study. In this scenario, Jack and Jill are a couple in their 30s with one child. They're currently renting in Dublin and paying €900 per month on their rent payment. They have savings of €12,000. Jack is employed as a city council labourer earning €32,000 per annum, and he has been in this employment for 3.5 years. Jill is a self-employed mobile hairdresser, and her accounts confirm that she is earning approximately €18,000 per annum. However, Jill has only been established as a sole trader in the last 18 months. They have no other debts or credit cards other than one hire purchase for their car, which costs them €450 per month in loan repayment. Jack and Jill wish to buy a 2-bedroom duplex in Dublin, which is going to cost them €100,000. In this case, there's no stamp duty applicable, and we're estimating that their legal fees will come to approximately €1,000. There will also be a mortgage valuation fee payable to their mortgage lender of €130. So the total amount that Jack and Jill will need to spend in this case is €101,130. When you take away their €12,000 deposit, they have a gap of €89,130, and it's this amount that they wish to apply for their new home loan. Let's look at the repayments on an €89,000 mortgage over a term of 20 years. As Jack and Jill are in their 30s, they would qualify for a mortgage term of up to 30 years. In this instance, they've opted for a shorter term, which reduces the interest cost they will pay over the life of the mortgage. The interest rate has been stress tested at 7%, which is approximately 2% above the standard variable rate that they will be charged. This provides a cushion or comfort for the mortgage lender to know that if interest rates do rise, Jack and Jill will still be able to afford their mortgage repayment. Jack's income as a City Council labourer amounts to €2,594 per month. However, in this instance, Jill's income has been excluded from the mortgage qualification purposes because she is self-employed for less than 3 years. When we remove their car loan repayment of €450 from their available net disposable income, it leaves them with an income of €2,144 per month. The proposed repayment amount of €691 as a percentage of their net disposable income amounts to 32%. This is within normal lending criteria and would mean that Jack and Jill's mortgage would be approved. The disposable income left in the household after the mortgage has been repaid is €1,453 per month, which is considered to be sufficient for a family of 2 with 1 child. Of course, they do actually have Jill's income from her self-employment. It just hasn't been used as part of the income qualification process. If for some reason Jack and Jill's mortgage application was declined, there are a number of areas that they could look at to improve the chances of securing an approval second time round. In this particular case, a recommendation would be to repay their car loan facility and to apply again after Jill had been self-employed for over 2 years, providing certified financial statements for her business. Other options to improve the qualification are to look at reducing the amount of the mortgage repayment and therefore reducing the overall percentage of their income that is being used to service the loan by taking a longer loan term. Alternatively, they could also look to introduce a guarantor or co-borrower for their mortgage application. Now we're going to look at the mortgage process. This slide will help you understand what to expect when you start the mortgage application process. Initially, you're going to be required to gather a lot of information and documentation regarding your current financial situation. Typically, this documentation will include your payslips, P60s, financial statements for your business if you're self-employed, copies of your bank statements, and savings and loans documentation. Of course, you'll need to have a copy of your photograph identification and a utility bill. The next part of the process is where you decide who to talk to about applying for a mortgage. You can either apply directly with a bank or you can work with a mortgage broker who will act on your behalf. When you have decided who's going to assist you in the mortgage application process, The institution, whether they be a bank or a mortgage broker, will issue you with a copy of what's called their terms of business. This document outlines the regulation that they're obliged to adhere to and the process that they will put you through in order to process out the mortgage. At this point, you're going to go through a mortgage interview. It's often referred to as a fact find, and it's where the lender will initially obtain all of their information about you, about your financial situation, and it will assist them in the decision-making process with your mortgage. If you're using a mortgage broker, the mortgage broker will research the market at this point and issue you with what's called a Reasons Why letter. This Reasons Why letter gives you an outline as to why they're recommending a particular lender for you or a particular mortgage product. If you're dealing directly with a bank, the bank will at this point explain why they believe their particular mortgage product is suitable for you and your circumstances. At this point, an application is submitted and the application is underwritten within the financial institution by a mortgage underwriter who makes a decision on whether you qualify for a mortgage or not. They may revert at this stage with questions or comments regarding your application, and it may require you to gather and submit additional supporting information. Hopefully at this point, what you will receive is an approval, or perhaps it's often called a sanction in principle. And this outlines the conditions that the lender is placing on the mortgage approval. You will then, if you've chosen your property already, have a property valuation conducted, and the property valuation will be submitted to the mortgage lender for their consideration. If the valuation and any other supporting documentation is in order, the lender will then issue what's called a letter of loan offer. The loan offer is a legal document and it outlines all of the terms and conditions pertaining to your mortgage contract. It's important at this stage that you visit your solicitor and they will outline and explain to you all of the important terms and conditions, and you will then sign the letter of loan offer. If you're buying a property, it's at this point that you exchange your contracts. Thereafter, you're in the closing procedure, and there are a number of documentation items that need to be submitted at this point. Some of these include your life assurance documents, your house insurance documents, and any other outstanding information that the lender requires. If this process goes smoothly, your loan check will then be issued to your solicitor, who will complete the property closing process for you. This overall process can take up to 3 months, and in some cases much longer, depending on the complexity of your application and the nature of the property that you're buying. That concludes this presentation on preparing for your mortgage application and understanding the mortgage process. If you have any questions, Home Brokers, an independent mortgage brokerage based in Dublin, would be delighted to assist you as you progress through your mortgage journey. Our contact details are here and we look forward to assisting you in the future.